Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated. Hey everybody, welcome back to the Working Wealth Podcast. I am so excited to bring you another educational topic we're going to talk about today. If you've been joining us for the past, really not several episodes, probably 10 or 12 episodes, we've brought on different guests to join us that are business owners, friends, professional experts in their fields to talk about their expertise in their business or expertise in growing a business and being successful. We are now taking it back to the basics. We started the Working Wealth Podcast as a great resource to be educational, informative, and encouraging to help people work on their wealth journey successfully, because we believe that it doesn't just take work to build wealth, it takes work to maintain wealth. And we want to help you be empowered with the right information and right education to really do that successfully, whether you're a client, if you're just someone tuning in, enjoying the show. So we're getting it back to the basics. And I brought on a new advisor on our team, Trevor Rasmussen. He's joining us today, and ongoing is the plan.
Yeah,
right?
Yeah, absolutely. Hey, that's my plan.
That's my plan. So no changes there. But brought on Trevor to talk about a very important topic today, which we hear all about online. If you get online, you're searching about retirement planning and financial planning, all that kind of stuff. One of the most common topics we see today is Roth conversions. So if it's a new concept for you, we're going to break down the basics and also some strategies and when it fits, when it doesn't fit. Maybe it's a recurring topic you're familiar with. You just need a refresher on things. Stay tuned with us. We're going to talk about a lot of details here. Before we go any further, if you have not liked, shared, commented on the show, please go back and do that and give us some good feedback. If you have negative feedback, keep it to yourself or shoot me a direct email. Would love to have that conversation with you directly. But we want your feedback. We want to be able to share this with more people and have a greater impact and greater influence in the financial world because of that. So let's dive on in. Trevor.
Yeah.
Welcome to the show, man.
Patrick, thanks. Thanks for having me on. This is the first time on the podcast, so I'm pretty excited about it, and thank you for the opportunity.
Yeah, no, we're super stoked to have you on the team and join us here today. And Trevor's a wealth of knowledge, has a lot of exposure and experience and knowledge in his head about financial planning. So let's dive straight in. Roth conversions. Man, I feel like everywhere you go, everywhere, LinkedIn, Facebook, Instagram, YouTube, like Roth conversions is the hot topic right now.
Yep.
So let's break down for people, what is a Roth conversion? And maybe even like not just that. What's the basics of that?
Yeah,
like the foundation.
Absolutely. So I actually was just going to go into kind of the foundation of what Roth dollars even are, what the different kind of classifications of each type of dollar that someone can have in a retirement account and a bank account, and how those are kind of all allocated via the tax code.
Perfect. Let's do it.
So first, we'll start with the clear and obvious one, which is Roth. Roth is kind of what I would describe as the superpower dollar, the one that is basically going to be going in to some sort of investment account, usually for retirement, that is going to grow tax-free. Mm-hmm. So you're going to be able to put that money into an account, let it grow over a certain amount of years, and then you're going to be able to pull it out completely tax-free. So it's really kind of that superpower, really awesome, strong dollar that just grows, and there's really no tax penalty associated with it. So we love Roth.
Oh yeah.
We recommend Roth to everyone that we come into contact with.
Yeah, in some form or fashion. Not blanket recommendations.
Not blanket recommendations, right. Obviously, but we really love Roth dollars. Second, I would kind of go into that pre-tax dollar, which is slightly different. Essentially, you can think about it as the taxes on Roth dollars being taken out of that money that you're putting in before it goes into the account. So, for instance, you're going to take your paycheck, for instance. Mm-hmm. You got your paycheck, you get paid. Your taxes are going to get withheld from that paycheck, And then from that balance that's left over, you can take those after-tax dollars and put that into a Roth account or into an after-tax account. Pre-tax is a little bit different. You're actually going to take the dollars from your paycheck. It's going to get deducted before taxes are even drawn out. And then you're going to have a smaller taxable bill. You're going to have a smaller paycheck, essentially, that taxes are actually drawn off of. And then those pre-tax dollars, those dollars that you pulled off before the taxes were taken, get thrown into an investment account or a retirement account. So the tax treatments are a little different around those. Roth grows tax-free. Pre-tax, you're deferring the taxes until a later date. You don't pay taxes up front. It's going to go into the account, grow, and then when you draw those funds out later on, you're going to pay taxes at your ordinary income rate, usually on those dollars.
Yeah. And so a simple way that I've heard people talk about before is essentially you can choose to pay the tax on the seed or pay the tax on the harvest, right?
Yep.
And whether you have, one field over here that you're planting or a field over here, ultimately you could net out the same way down the road. But that's where we have different strategies we can look at, like Roth conversions, withdrawal strategies, distribution plans, all that kind of stuff.
For sure.
Thanks for breaking that down. So so the Roth key thing there is the primary reason we love Roth dollars is because it's tax-free growth, right? For most situations, there are a couple of caveats you have to satisfy to get the tax-free growth, but you get that benefit over time. So what is a Roth conversion?
Yeah, Roth conversion really at the simplest core of what it is taking pre-tax money. So for instance, in maybe your employer-sponsored 401k, and you're converting it into Roth dollars. Now, the process is really straightforward. You're just taking that money and you're moving it into a Roth account usually. And there is a taxable implication there, and that's really kind of the planning piece that comes around Roth conversions. But at its core, it is just taking pre-tax dollars and converting it into Roth dollars. So taking that tax deferral down the road, you're going to pay the tax up front to be able to let it go in and grow tax-free for later.
Yeah, perfect. So clarify for everybody here, if we're thinking about doing Roth conversions, because again, it might just be the algorithm. Like it seems like every day 1,000 posts about it, but are Roth conversions always a good idea?
No, I would say not. It definitely depends on your specific situation. What we really like to look at Smart Pro, Patrick, is your taxable income in a given year. So, let's just take 2025, for instance. We'll take your income and all of your adjusted gross income for that year. And based on your certain thresholds and your marginal tax bracket, we will adjust accordingly whether Roth conversions are appropriate and in what amount essentially for that year. And we can get into the weeds on that if we want to, but essentially it's really about how much money you make and adjusting the amount that we convert in that year to keep you in a tax rate that's acceptable for you in your situation.
Yeah, I appreciate that. And so the key thing to that point is it really goes back to what is your income tax rate?
Yep.
And that's where I think a lot of times people get confused or they feel like, oh, here's this strategy and I got to make sure I have all my money in Roth down the road. You really don't.
Yeah.
We love that for a lot of reasons. Like Roth dollars, number one, it is tax-free growth.
Yeah.
So if you have a long horizon to let that money grow, it's tax-free. It passes down to your beneficiaries or whoever's going to inherit your assets completely tax-free. Yep. It gives you full flexibility that when you do in retirement need to buy a car or you have a $15,000 or $20,000 expense and it's a lump sum. Well, we're in control.
Yep.
We are 100% in control of what our tax implications will be because we've made that decision before to have the freedom and flexibility to take money on our own accord.
Yep.
One of the things I've heard some other successful advisors say also is that pre-tax dollars are actually an unsecured loan with the IRS because really your ultimate tax implication for pre-tax dollars is based off of whatever the IRS determines your tax rate will be in the future.
Yep.
So it's like if I were to take on a mortgage for 30 years and I start paying on this mortgage, but I'm never told what the interest rate will be. And I'm actually not even told how much the mortgage is, right? I just take on this completely black box loan and I have no idea about it. but I know that I have to keep putting money in over time, right?
Yep.
So we don't like that. We want people to be in control. We want people to have flexibility, have freedom, and be able to act accordingly with independence down the road for their future.
Yeah.
So thinking about like actually the mechanism of the Roth conversion, we say the primary thing that's going to drive that is your income tax rate at the time of when money's going in, and then also the time when money is coming out down the road. We've already said that Roth conversions are not always like there's not 100% guaranteed like always going to work strategy. Every strategy has its pros and cons. We don't let the tax tail wag the dog.
For sure.
Right? If you are in a high tax bracket today and you're going to be in a low tax bracket down the road, we can math that out from a dollars and cents wise that maybe that doesn't work for the tax benefit, but it could work for the flexibility.
Absolutely.
Could work for the inheritance.
Yep.
Could work for freedom down the road, for generational wealth.
Yeah.
All those kind of things.
And I think that that's a really great point. Roth allows ultimate flexibility. And so even if the tax situation doesn't work out for you, if it makes more sense to actually invest pre-tax dollars instead of Roth based on the income that you're making, and obviously we've got the Roth limits for income and what you can actually make. So if you're over the certain threshold for that given year, you actually can't contribute to a traditional Roth IRA. I said traditional and then Roth right back to back to a Roth IRA.
Yeah, right.
So there are a lot of things that play there, but really, like you said, Patrick, it's about flexibility. Roth allows you to control when your money is used, which tax rate, which is 0%, it's used at, and when you can pull it out after 59.5 without penalty. So it really does give you that versatility and that flexibility, and that's why it's so powerful.
Yeah, perfect. So let's talk about one of the primary examples or one of the primary reasons we come across all the time of why we might consider a Roth conversion. So I want to talk about specifically RMDs.
Yeah.
So RMDs, we talked about this in past episodes as we've broken down acronyms, and we call it the alphabet soup of the investment world. But an RMD is a required minimum distribution from your qualified retirement accounts. So just very short, very quick, I mentioned that pre-tax dollar going in is kind of an unsecured loan with the IRS. You don't really know what the terms are going to be. You just know you have some kind of tax liability in the future. The RMD is a required distribution that once you hit a certain age, if you have pre-tax dollars, the IRS is going to force you to take a certain percentage of that account balance out on a yearly basis. Yep. That percentage grows each year, but then also as your balance grows, the amount grows each year. And you're forced to take that money out and pay tax on those dollars. Now you can, of course, reinvest that money. Yep. You can put it into a brokerage account. You could give it away to charity. You could use it for medical expenses. You could blow it in Vegas, like whatever your heart's desire is, right? But the key is this is really one of the core things we look at in terms of control of our assets. And what we see a lot of people have today, like a lot of people that are coming close to retirement, maybe in the next five years or less, that has a sizable amount. This could be a couple $100,000 based on depending on your situation. That's a sizable amount. Yeah. We also have a lot of clients that have $3, $4, $5 million, right, of pre-tax dollars. We see a lot of these situations where maybe we're looking at, a 63-year-old that has, we'll just say $1 million in pre-tax dollars. And because of the way they live, because of their lifestyle and the decisions they've made, they really don't have a need to draw all that money, right? Once they say they're 62 today, the RMD age for that person who's 62 today is going to be at age 75. You got to start taking those required distributions. Yeah. And the problem we see all the time, right, is invested modestly, just modestly. Over those 13 years from 62 to age 75, just a balanced portfolio, that money's going to double. Yep. So it's like
or more. I mean, double could even triple.
Right. Just based on historical markets, right? Like we're saying, let's say $1 million becomes $2 at age 75. Well, if you didn't need that money to live off of, like you've got pensions or Social Security, maybe you have part-time work or a business or real estate, things like that, or maybe you have to just take like $1,000 a month, right? Something like that to support your living. That money's going to grow. And let's say that 1 becomes 2. And based on the current tables, the first year distribution is just under 4%. I think it's like 3.89-ish% of the balance. Yep. That means, let's round it up to 4, make the math easier. 4% of $2 million. You got to take $80,000 out. whether you need the money or not,
Yep.
and you've got to pay taxes on it.
Yep.
And for a lot of people, that's not a good situation. Like if you're taking 80 grand out, more than likely, if you're not needing the money, you're probably already in the top end of the 12% marginal tax bracket under current laws. That's going to put you into the 22% bracket.
Yep.
So if I got to take 80 grand out, just on the federal level, by the way, if I got to take 80 grand out, more than likely, let's just do that math, I've now got to pay, what is that, $17,600-ish of federal taxes that I didn't need to pay.
Mm-hmm.
And I didn't need the money, so now I've got to pay the tax money, but I'm left with, what's 17.6 out of 80 grand? You're $64,000-ish, right?
Yep.
$63,000 that I'm left over with that I've got to do something with.
Yeah.
Which the cool thing is it's your money, right? You get to do what you want to do. But this is all based on current tax law.
Yep.
Right, current rules.
What if in 20 years that tax rate goes from that marginal rate goes from 22% to 32%? Now we're talking about, a 10% increase above what you were already forced to pay taxes on.
Right.
So, that's a great point, Patrick.
Yeah. So the onus on that, or like the reason we bring that up, is that's one of the most common scenarios we see is like people that have a large pre-tax balance and they're looking at like this potential impact that most people don't even know about. It's kind of this like unspoken, like lurking in the background, like tax implication that nobody thinks about. And we want to make sure people are strategic about that.
Yep.
And that's where we look at on a year-by-year basis. Okay, what are our pre-tax dollars? What does our marginal income look like? And should we or could we do something more beneficial down the road by converting some of those dollars to Roth?
Yep.
So what are, I said a lot of stuff there, right?
Yeah.
What are some of the potential gotchas or pitfalls we have to look at if we're looking at that scenario, just based on your knowledge? Not to put you on the spot.
You talking about like RMDs in general, or are you just talking about when we're actually converting those dollars? What are the pitfalls that we can run into?
Yeah, when we're actually converting, like what are the things we have to pay attention to?
Yeah, absolutely. I mean, I think the number one thing is your income. Where's your income in that given year, and what's your tax rate on that income? Because if you're already in a really high marginal tax bracket, which I would consider 24% and up, 32%, 37%, you're already giving away 3 to 4/10 of your income just based off of your job, the income you're bringing in from your business, your job, whatever it is. If we were to convert pre-tax money into Roth and do Roth conversions in that year, we're just adding that marginal rate onto all the dollars that we convert. So for instance, to make it simple, let's just say you're in the 37% tax bracket for 2025. And you want to convert 10,000 pre-tax dollars into Roth dollars, $3,700 of that 10 that we're going to convert is going to go right to the government, right in that moment.
And that's just federal. That's not even.
That's just federal.
That's including your state and maybe you have some local taxes, things like that.
Exactly. Yeah. So the baseline is 37% if you're in that marginal tax rate. So really, I would say the number one thing that we're going to look at is where is your income in relation to that year and what's your marginal tax rate. If you're at a level of income that is in a lower tax bracket, you're in the 10% or the 12% bracket, it might make more sense for you in that year to convert some money up to maybe the limit of that marginal tax bracket and get that benefit now while you're only paying 10 or 12% on those dollars instead of 37%. So really, it's going to be case by case. It's going to be dependent on where you are in your specific situation for that given year. But definitely. We're not going to recommend Roth conversions to someone who's in a really high marginal tax bracket, especially if their income might come down in the next couple of years. Yeah. We run into that a lot with retirees, where we've got people who are doctors or lawyers. They're making $200,000, $300,000 a year. They're in a really high tax bracket, but they're going to taper off and retire, or they're going to slow down and reduce their hours in the next 2 or 3 years. For us, that kind of gets our wheels spinning of saying, okay, well, hey, your income is here now, but in a couple of years, it's going to be a lot lower. So we can take advantage of those conversions then rather than right now.
Yeah. And I would even say, like, to that exact scenario, flip it back around to what you were talking about earlier, is maybe we have a gap where we know our income's going to be lower for the
Yeah.
next few years. Like if I'm 60, 61 years old and I have a pension that starts at 65
Yeah.
and I'm deciding to defer Social Security as well until 65, 66, 67, full retirement age, we might have a 3 or 4 year gap where we could convert 30, 40, 50 grand at a time and start making that money go Roth instead of pre-tax.
Absolutely.
Pay the tax bill on that today, and then now you have more freedom and flexibility.
Yep.
And this, in my mind, goes back to why it's so important to have someone in your corner.
Yep.
Not just anybody in your corner, somebody who knows what they're talking about, somebody who's competent and specializes in doing this kind of stuff every single day with their clients.
Yep.
Like Roth conversions are not an afterthought for us. This is something we look at strategically for almost every client every time we talk. And even if it's something we don't like explicitly bring up in conversation, it is something that's on our minds as we're looking at income, if we're reviewing an asset map or a right capital plan, things like that. We're looking at these things.
For sure.
We spoke with a client earlier this week that based on their income, they do have like a lower taxable position for the next couple of years.
Yep.
And now we're having a conversation with their CPA because we're not the tax advisors, right? We work with their qualified tax professional to clarify, well, how much money can we convert and what is that actual dollar impact?
For sure.
So one other, I think, very important kind of gotcha we got to look out for, though, is a special tax that can come into play once you reach age 65 that a lot of people aren't aware of. And this is called the IRMA tax.
Yep.
So everybody knows about Uncle Sam. Everybody's greedy uncle, right? They're going to get his tax revenue. We have also on the other side of the fence is Aunt Irma.
Yep.
And IRMA is the income-related monthly adjustment amount for Medicare. So IRMA is just, you have your baseline Medicare costs for Part B and Part D. This is an added cost depending on how much your modified adjusted gross income is each year.
Yep.
Now, there is a 2-year look back. So like for 2025 Medicare cost, they're looking back at your 2023 tax return.
Yep.
So this is where, again, there's a lot of strategy we have to look at is like maybe someone is in the top of the 12, low 22% tax bracket, and they want to convert 100 grand because it makes sense based on their total portfolio or their other income down the road, all that kind of stuff. We have to be very cautious or at least understand the implications of doing that conversion and possibly pushing them into a higher IRMA bracket, which now takes their Medicare costs from, we'll say, $200 a person per month to maybe $270 a person per month, which hopefully for most people, if we're in that situation, we're doing that, like an extra $70 a month is not going to be a critical thing, but that's going to stick with us for a couple years, right? So we have to be cautious of those things.
We have to weigh those risks. We have to understand what that picture is going to look like and then tailor it to the specific, individual or family that we're working with. And so I think, Patrick, to your point, this is why it's so critical to have someone in your corner and, someone that's got your best interests in mind when you're working through your plan. We like to say that you've got one retirement. We help hundreds and thousands of people go through retirement. So being able to walk through that process with someone who's doing retirement for the one and only time they're going to do it, they need that professional in their corner that's going to help them through that's seen hundreds of people through that process.
Right. Exactly. And it's not just, I think I'm actually going to dig in on that a little bit more, is like not just somebody that knows it in theory.
Yeah.
Because I feel like a lot of the talking heads you see, the Instagram, the social media posts, whatever platform, a lot of people are talking about these things in theory, but they've never actually done it for themselves or helped other people do it.
Yep.
I've done Roth conversions for myself,
Yeah.
right? We've helped literally over 100 clients do Roth conversions over the past couple of years. The key point is knowing how it's actually going to work out and not just doing something, not validating our information ahead of time. And that's where, again, I see a lot of risk is, you see Reddit posts or YouTube videos where people say, convert all your money to Roth right away. And then we get calls that say, I got $2 million in pre-tax. I want to convert it all. I'm like, whoa. Like, there's a lot more impact there and a lot more planning mechanisms that might lead us to say we shouldn't do a Roth conversion. So I want to talk about one of those that I think is really important, which is a lot of people are concerned today about long-term care.
Yeah.
And they're concerned about, I have a family member that was in a situation where they had long-term care. We ran out of assets, right? They had to get into a Medicaid situation, those kind of things. Or it's just hey, I don't have a family member who's been through it, but I have health things and I can't afford long-term care insurance or I can't qualify for it because of my health. What am I going to do? And that's where there's another side of this fence where it might not make sense to actually be focused on doing all of our Roth conversions, getting all of our money over, because when you get in that situation to where you are maybe having to pay for long-term care, which is qualified medical, qualified healthcare expenses, there's a special tax rule that you can deduct any qualified medical expenses over 7.5% of your adjusted gross income on a yearly basis if you itemize your deductions.
Yep.
So the key thing to note there is, let's say that I do have a long-term care need and I've got to pull out $100,000 a year from somewhere, right? And I'm going to end up pulling it from my retirement accounts, and I've got to just live off the money that I had. Well, if my income was already, say, lower, like below $100,000, and now I'm having to add on $100,000 of income for pulling out of a retirement account, which is a taxable distribution coming out of that pre-tax account, I'm adding that income on, but I can also, assuming these are actually qualified medical expenses, I could probably deduct the majority of that additional income I bring on because I'm increasing my adjusted gross income and I have all these expenses, where I might be able to deduct the majority, if not close to all of that income that I'm pulling out.
Yep.
It's a lot easier to talk about with like real numbers. I get that. This is like me saying things theoretical that we have also done in practice, just to clarify. But that's one of those reasons where I say, in a lot of cases, like tying all the different facets of retirement planning together, you don't need to just take one thing and say, this is the hill I'm going to die on.
Yep.
Right? I think anytime you look at it in a binary fashion of this is right and that's wrong, you set yourself up for failure.
Yep.
Right? Instead of being dynamic and being able to adjust and ebb and flow with how the laws change and how your circumstances change.
Well, and that was one other thing that I was going to bring up. You know, we were talking about tax rates and not really knowing what they're going to be in the future. And the tax code has changed 5-6 times in the last couple of years.
Yeah, it feels like it, right? I mean, you had 2019, you had 2022, 2023, 2020. I think there was something last year.
Yeah.
And if not last year, definitely this year, right?
Exactly.
So all these different bills.
Anytime we get a new, regime in the White House, anytime we get, a new midterm election coming up, anytime anything happens in the stock market or the economy, there's always these ebbs and flows, like you were saying, and these adjustments, and the tax rate is constantly changing, and people's situations are constantly changing. So it makes no sense to apply a blanket statement and say this, Roth conversions are that's the thing. Like everyone's got to get on it. If you don't get on this train, you're behind. That just isn't the case. We see that with so many of our clients. It's really dependent on your situation. Yeah. Sometimes it makes sense. Sometimes it doesn't. Sometimes it makes sense this year, but not next year. Sometimes it makes sense 3 years from now, not now. And so really it's just figuring that puzzle out and putting all the puzzle pieces together to make sure that everyone's got the best possible situation at hand. And that's what we really strive to do with each and every one of our clients.
Yeah. No, that's a great note. And I want to add to that too is for the next few years, because of the recent tax law change, now is probably a really good time to look at this. Right? Specifically if you're age 65 or older, you have the enhanced standard deduction under the One Big Beautiful Bill Act. I heard a rumor they're going to change the name of that. I haven't seen the official word on that. But under the Big Beautiful Bill Act, or the OBBBA, you have that the enhanced standard deduction, which is essentially an extra $6,000 per person over age 65 for the next few years. So at a minimum, like maybe we consider converting $12,000 to use up that standard deduction.
Exactly.
Right?
Yeah.
And just start making some progress in that direction.
For sure.
That's kind of like a bare bones, like minimum threshold thing we're seriously looking at for our clients as we're doing reviews, because if nothing else, right, maybe we could be tax neutral. Maybe you don't convert 10, maybe you convert, or maybe you don't convert 12,000, you convert 10,000. And then you've got a little bit of extra you could use to pay the taxes, like that kind of stuff. But again, like every rule, every tool has its place. I'm not going to use a hammer to paint a room. It could work, but it's not very effective, right? Yeah. And you just have to know how things work and how they fit. So going into a little bit more of a strategic side of the Roth conversion. So we talked about like you've got RMD, reductions and avoidance. You got to watch out for IRMA taxes, the increased Medicare costs. Talked about the extra standard deduction. We love the flexibility. We love the freedom. We love putting you back in charge of your money and making sure you have your hands on the reins, your hands on the wheel as much as possible, right? This is definitely one of those things from a strategy perspective is you have to know the potential pitfalls. And one of the key things we have to pay attention to is anytime we do convert money, you invoke something called the 5-year rule. Now, a lot of people that are familiar with Roth dollars in general, they know about the first 5-year rule. The first 5-year rule is any money you put in, you can always take your contributions back out, tax and penalty free. So if I'm just funding a Roth IRA myself each year, I can take that money back out. But you have to leave that money in for at least 5 years before you could take that growth out tax free. So 5 years plus over age 59 and a half years old. It's essentially what it is. Well, anytime we do a Roth conversion, there's another 5-year rule that comes into play. For every converted dollar, every time we do a conversion, there's a 5-year hold on those dollars we converted before we could take growth associated with those dollars. So if I do a conversion today, I can't take that money out tax and penalty free. The growth, you can take your contributions, but like your growth, you can't take out tax and penalty free until today's 2025. So basically 2030. Right. And that's one that a lot of people miss, and we actually had some clients recently that we did conversions 3 years ago and they said, well, hey, I need to take this money out. It's like, let's look at what's the most optimal situation because there is that 5-year rule that we talked about. It's in email, by the way. we try to document our notes as best as we can. And you just have to be cautious of that. So that's where, again, you see a lot of people just throwing advice out on the internet and they really don't know. They haven't done it in practice. They don't know all the intricacies. It's just fancy words and things to talk about.
And this is exactly another, brings up another point. Let's just say you've got someone who's retiring or they're in retirement and they need to live off of the accounts that they're managing right now. So let's just say they have a pre-tax retirement account. It might not make sense if they need to live off of those dollars right now to convert them to Roth, like you said, because we've got that 5-year window where we've got to wait before we can get the tax-free benefit. It actually might incur more damage and more tax than just leaving it in that pre-tax account and letting them draw off of that. And once again, it's very specific, but that might be an instance where it doesn't make a lot of sense. If I'm living off these assets now, I need them now, I need to draw off of this account. I'm not going to convert dollars and then draw off of that because it's going to incur all those taxes.
Right. That's a common trap that we see people, luckily we don't see a lot of people actually do that, but we hear about those things all the time. And those are the questions people are asking is, hey, I want to do this. And we're like, well, full stop. Let's actually evaluate your situation. Let's make sure we're thinking about this the right way. No, that's perfect. Another thing that we believe is really important is when you're doing a Roth conversion, let's say you have a $10,000 tax bill associated with it. We want to be able to pay that tax bill 9 times out of 10 out of other cash savings, not from the dollars that are being converted. Now, if you're already in retirement or you're of age above 59 and a half years old, in some cases we would say, yeah, you're converting $100,000. It's going to be $12,000. Ballparking or throwing out a random number, then let's actually possibly take some of that from the conversion amount. A big challenge though is like, let's say I'm not 59 and a half and I've got a Roth IRA and I want to convert 10,000 out of a $100,000 balance. Well, let's say my marginal tax rate is also 12%. So I'm going to convert 10,000. My federal tax liability is going to be $1,200 based on that marginal rate. If I take the $1,200 out of the converted amount, meaning I'm going to take $10,000 out of my pre-tax account, I'm converting that over to Roth there. I have $1,200 of the tax liability come from that distribution. $8,800 actually goes into the Roth IRA from the $10,000 we converted pre-tax. If I take that $1,200, that is actually a non-qualified distribution from a retirement account, and I'm subject to the 10% tax penalty on top of the regular income tax. So it's a 10% tax penalty on whatever comes out. So like, let's say I had the $1,200 liability. Now I've got a $120 tax penalty for that money that came out as a non-qualified distribution.
Yep.
So,
and these are all things that we're thinking through when we're navigating this with clients.
exactly.
We don't want people to have to pay that extra 10% tax if they don't need to.
Yeah. Yeah. We consider that as like, that's like buying a lottery ticket knowing you're not going to win, right?
Yep.
It's like, you know, this is a loss. We can avoid this loss. We can actually be more strategic. We can be more focused and do things right. But that's also where I don't want this to get lost in the conversation is that's where we don't just make these decisions willy-nilly, right? If you have a CPA or an EA you work with for your taxes, we want to bring them into that conversation. And we're constantly talking with people's tax advisors, via email or phone or even having them pull into a meeting. Let's look at the tax return. Let's do a scenario analysis of where we are today and what that could look like to make sure we don't do anything that's going to be like have a negative impact for their financial situation.
Yep.
So.
And yeah, that you need the team, you need the full team, you need the CPA, you need the financial advisor, you need the lawyer in some cases. You've got that group of people in your corner all fighting for you, working together to make sure that your situation is the best that it can be.
Yeah, exactly. Yeah. Awesome. Well, any final thoughts? I know like there's also other applications of doing Roth conversions because the conversion is just a tax mechanism, right? It's a tool we can use. I can pull out my multi-tool and I can pull out the knife blade or I can pull out the scissors. I can pull out the corkscrew. Like it's one of those things on the Swiss Army knife, right? I don't think we're not gonna go into like all the other like use cases
for sure.
But just for reference, what are some of those other use cases we think about with the Roth conversion specifically?
Yeah, I mean, I think you can go into different strategies. You're more talking about like you want to
mega.
Yeah, absolutely. Kind of so this is where financial advisors, we love to talk about this stuff because this is when it gets really in the weeds and gets really nerdy.
Yeah.
But we've got mega backdoor Roth conversions. We've got backdoor Roth conversions, and essentially those are really fun strategies to talk about. I can get into that if we want. But
I'd say bullet point summary.
Yeah. Bullet point summary. Essentially, if your income is above the yearly threshold, Roth accounts, especially Roth IRAs, have income limits. So essentially, if your household income is over the threshold for just putting money into a Roth IRA, normally my income is under that limit. So my wife and I, we can put money into our Roth IRAs each month, each year, whatever we decide to do. People that are above that threshold can't actually put those dollars into Roth accounts in the standard way. That's where backdoor Roth conversions and conversion strategies come in. Essentially, bullet point there is you're going to take money that you can't put into a Roth IRA directly. You're going to put it into a traditional IRA in pre-tax dollars, and then you're able to convert that after it goes through that account. So essentially, you're backdooring it, you're putting it into another vessel, and then switching it and moving it, converting it into that Roth account. So it allows people to still get those dollars into their Roth IRAs without being able to do it on the front end. Yeah. You go through the back door, through the traditional route, and then you convert it.
Right, exactly. And that's another thing we want to emphasize too is like every tool has a place. Every strategy has a place. Every use case has pros and cons. Like even doing the backdoor strategies, there are some pitfalls, some additional tax rules. The IRS has, you might not believe it, some of the smartest people in the world writing the tax code. They've thought of most things, right? And they know how people might try to skirt the system and work around the rules and try to get a better benefit for themselves. So there are some of those like gotchas or strategies where you have to be cautious around how to do that stuff. That's where, again, we recommend work with professional, be diligent on evaluating all scenarios or all situations around your plan to make the best decision possible for your future.
Yeah.
So thanks for sharing that. I appreciate that.
Of course.
Any other final words you think we should just reemphasize or specify for people today?
Yeah, I just think we can't overemphasize the fact that when you're talking to us, when you're talking to your financial advisor, bring the strategy up to them. See if it makes sense. If you've got pre-tax retirement accounts sitting in your portfolio, maybe it's a good thing to just bring it up, ask the question, hey, are Roth conversions, are they viable for me right now? Are they good for me? Would it be a good thing to do? Is it a good strategy? And have that conversation, because the worst thing that can happen is we look at it and say, not this year, or no, it doesn't make sense for you. But there's so much benefit that you can unlock inside of that strategy if it applies to you, that it's worth having the question and having the conversation. So I would just say bring it up, talk to your advisor about it, and see if it's a good strategy for you.
Yeah, and shameless plug here. If you bring it up to your other advisor that you don't work with us, and you bring it up to your advisor and they don't know what you're talking about, give us a call.
Yep.
We'd be happy to talk about that with you. Make sure you have the right advice and the right person working out with you there. Trevor, thank you so much for joining to talk about Roth conversions today. We've got a lot more content pieces around investment strategy, estate, insurance, cash flow, business, tax, all that stuff that we're going to be recording over the next few months to get more educational content out to you guys. But Trevor, thank you for joining. If you haven't gone back and watched our other episodes, about a year or so ago, if you're watching this fresh and newly released, we had a lot of information put out there around Social Security, around different account types, the alphabet soup of the investment world. Take a look at all those things, review it, share it, ask us questions, and we'd be more than happy to get you guys on the right foot. So y'all have a great rest of your day, and thank you for your time. Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated.